Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, February 1st, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So, starting with today's key macro event, as the Fed throws cold water on Goldilocks amid more evidence of a soft landing in the U.S. economy. So, the nuance there yesterday's FOMC event overshadowed positive signals for the economy and liquidity stemming from this week's deluge of U.S. labor market data and the January 2024 QRA. Powell definitively took a March rate cut off the table, citing the need to see more good data on the inflation front. Fed Fund futures now see a 60% chance of the first cut at the May 1st FOMC after having priced that outcome into the March 20th meeting prior to yesterday. Elsewhere, today's Q4 productivity and unit labor cost data reconfirmed the confluence of well above trend productivity growth and at or below trend unit labor cost inflation, which is positive for corporate margins. What is positive for corporate margins is positive for the business cycle because it reduces the need for corporations to make significant cost reductions that may have an adverse impact on the labor market. Moreover, it reduces the need for corporations to pass on cost pressures to customers, lowering the probability of an adverse monetary policy response in the future. In terms of market implications, from a medium term perspective, what is good for the business cycle is good for the current Goldilocks market regime. From a short term perspective, fresh signals from our positioning model, volatility adjusted momentum signal, and discretionary investment ideas summary imply or incrementally imply elevated risk of a cross asset correction in the near term after yesterday's bearish signals preceded the accelerated sell off during the Powell presser. Today's fresh signals have dour implications for our systematic KISS portfolio construction process as well, and we will be booking gains and taking down risk as a result. Transitioning to my 42 macro dashboard here. As always, we'll start with trading range signals from our friends over at Longbow. We are getting oversold signals, not quite oversold signals here in NASDAQ, getting close to the lower boundary of the range, getting close to the lower boundary of the Russell range there. But we do have our trading range signals are a little bit different from the signals at Longbow, so a little not quite as close to the bottom end of the range in terms of our probable range model. In terms of the bond market, big, obviously massive move in rates this week. Getting an oversold signal here on the 10-year nominal treasury yield, an oversold signal here in the 2-year nominal treasury yield, as well as an oversold signal here in the 10-year TIPS yield as well. So be a good spot to be kind of booking gains or taking off some risk in bonds, just given the sharp rally we've seen in recent weeks. We're also getting a near overbought signal in the VIX, but again, not quite overbought with respect to our probable range process. And then lastly, transitioning to our 42 Macroware community. Getting a question this morning in response to my morning tweet this morning. So the question reads: I caught one of the questions from the press conference yesterday. I'm paraphrasing, but a reporter asked if they were using more precise tools to calculate inflation. OpenTable, Zillow, and JP responded, no. It's not that the pandemic anymore, so they were using more traditional measures. Seems a bit strange that if it worked during the period, why would it go back to using more archaic measures if there's so much private data around to calculate inflation? So I do want to make a correction here. That question that the users, the client is referring to, it was not responding with respect to inflation. It was actually with respect to growth, the actual what's happening in the economy in terms of open table reports, et cetera. Powell actually did specifically cite home price data from survey based, sort of from observational based places like Zillow, et cetera, in terms of expecting an accelerated disinflation process in reported shelter inflation in the coming months. Obviously, we need to see that data. They need to see more good data, as our morning note implies, before they get more confidence to implement that first of what is likely to be a series of technical rate cuts to prevent incremental policy tightening. So, just kind of taking it back a broader view on the question. So a lot of these data points, that have since come around, in the post-pandemic era, whether it be things like open table, some of these more super hyper high frequency data points, we have to remember that we don't have long-term time series for these data points. So we have no idea how they behave in various phases of the business cycle. So, they can't be reliably used to predict anything from a forward-looking perspective. They're great at telling you what exactly is happening now, according to that particular survey, but they're not necessarily great at telling you exactly what's likely to happen in the future based on previous evolutions in previous cycles. So that's kind of one downfall to overly relying on that type of information. And then the second downfall is that these aren't necessarily thoughtful predictive thoughtful indicators. Something like CPI, it's been debated, deliberated, and executed, and consistently executed, more importantly, across multiple generations. And so that data is actually, even if it's not a perfect measure of prices in the economy, and I'm not so sure that there is a perfect measure of prices in the economy, given that we all have different inflation baskets as individual consumers and businesses. But I digress. There is no perfect measure for something like inflation or for something like growth. We are doing the best we can in terms of using statistics like GDP, CPI, PC deflator, etc. But I think just generally speaking, as an investor, it's our job to understand what the current market regime is and what the next market regime is, and repositioning when it's time to reposition. That's if you're doing anything more than that as an investor, it's probably you're probably not making money on a consistent basis. And so we are using here at 42 Macro all the available tools, all the available data to help us stay on the right side of market risk. So we're having very confident about our process in that regard. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, February 1st, 2024. Everyone have a wonderful day out there. We're going to be in a research cave today, preparing our February 2024 macro scouting report presentation for tomorrow. So clients be on the lookout for that in your inboxes early tomorrow afternoon. Cheers.